In this video tutorial, we're going to go through assignment problem 7-2 from your textbook. So make sure that you've completed this problem on your own first before continuing on with this video solution. Now, if you haven't done so or you don't have a copy of the problem, here is the first part of the problem. So pause the video, read through this first part, and then I'll scroll down to the second part, which gives other information and the required right down here. So make sure that you read through this, complete it on your own before you resume with the solution. So pause the video now before resuming with the solution. Now, before we begin the solution, just a couple pointers about rental income. Now, remember that for individual taxpayers, they're not permitted to create or increase a net rental loss by claiming CCA. So when we talk about net rental income before CCA, that could include things such as recapture and terminal losses on the disposition of the building or any furniture that's within the rental properties. And also buildings go into class 1, and they have to go into a separate class 1 if the building costs more than $50,000. Now, prior to 1988, buildings went into class 3. So we notice on this question, the buildings all except for Mark Avenue are in class 1. Mark Avenue is in class 3. So that would be a 5% CCA rate. Now, there's no adjustment if an individual taxpayer buys the building partway through the year. They don't have to use the short fiscal period adjustment. They get to take the CCA for the full year. And also, because we're in the year 2020, those enhanced CCA rates, that accelerated investment incentive, would apply as well. So if we look at the required, it wants us to calculate the net rental income for 2020. And we need to do a separate CCA calculation for each property and specify how much CCA should be taken for each building, and also any other tax consequences as well. So let's first start with calculating the net rental income before CCA. Now, they've already done that for us on the individual properties, so that is fairly straightforward. When we talk about calculating net rental income before CCA, we just take all the rental income, all the receipts, minus all the expenses related to operating that rental property. So if we add up these four amounts, that's going to give us our starting point. So let's start with our net rental income before CCA. And once again, if we add up those four amounts, that's going to give us $18,331. So that's the starting point. Now we're going to just sort of leave that there for now, because there could be other amounts such as recapture, terminal losses, that we have to add to this balance before we consider how much CCA we can take. So then all we're going to do is work through each of the properties one by one. Let's start with the property on Hart Street. So we look at the property on Hart Street that was acquired during 2020. So we know that at the beginning of the year, the UCC for this property would be 0 because it was a brand new building. During the year, we bought the building for $1,180,000. Now, all the amounts in this question are excluding the land. Obviously, there would be land involved as well with the purchase of a rental property, but in this question, we're just sort of ignoring that aspect of the purchase and disposition. So we're just focusing on the building aspect. Now, because this was acquired in 2020, the accelerated investment incentive would apply. So we have to add 50% of that to our CCA base. That's going to be $590,000. And so our CCA base for calculating CCA is going to be $1,770,000. Now, we're not going to actually figure out how much CCA we can deduct until later on, but let's just figure out what would be the maximum CCA we could take if we had enough income. So $1,770,000, this is class 1, so let's just put class 1 here so we don't forget this is a class 1 asset, which is, in our example, 4%. We will multiply that by 4%. So the maximum CCA we could take if we had enough income would be $70,800. So we'll just sort of leave that there for now. until we can figure out how much CCA we're allowed to take. Now, the next building is going to be Barton. And if we look at Barton Boulevard, we have the capital cost, $307,500, the UCC, $266,250. And this Barton Boulevard property was sold during 2020 for $231,000. Now, there was also some furnishings attached to this property, which was put into Class 8. And at the beginning of the year, the UCC balance was $4,498. These furnishings were bought several years ago for $28,750. Now, they simply gave the furniture away to the former tenants. And so this would be a disposition for tax purposes. Now, the proceeds of disposition would be zero. They got zero for giving these furnishings to the former tenants. So we have Class 1 building that was disposed of, and also Class 8 assets that were disposed of as well. So let's set this up, and let's put Barton Boulevard down here. So for Barton, we're going to have both Class 1 and also Class 8. And we'll just start off with the UCC at January 1st. Now for the building, the UCC was $266,250. Now they disposed of the building during the year. And whenever we dispose of a depreciable asset, we have to deduct the lesser of cost or proceeds from the CCA class. So lesser of cost or proceeds, the lesser is going to be the proceeds of $231,000. So we deduct that. That's going to leave us with a balance of $35,250. Now, because each building has to go into a separate class, there are no more assets left in this class. And so we said that in Chapter 5, whenever we have a positive balance in a CCA class and there's no assets remaining when we get to the end of the year, this is known as a terminal loss. And that amount we get to deduct when we calculate our income. So in this example, when we calculate our net rental income, we get to deduct $35,250, and that's going to reset this class to zero. So we'll add that to our net rental income after we finish Class 8. Now with Class 8, we start off with a balance of $4,498. Remember, we sold it for zero proceeds because we gave it away. We deduct the lesser of cost or proceeds. The lesser is going to be proceeds of zero. And we also have a positive balance in this class. Now, we have no more assets left because we gave all the assets away. And so we also have a terminal loss, which is a deduction from income. And so that's going to reset this class to zero. So let's move these two amounts up to our calculation for net rental income. So we'll back up to net rental income. We're going to add the two terminal losses. So the first amount was $35,250, and the next amount was $4,498. So that's the Barton building. Let's look at Mark Avenue. Now with Mark Avenue, this is a Class 3 asset, and if we scroll down to the question, we'll see that during 2020, she spent $78,750 on improvements to the property on Mark Avenue. Now, these improvements enhance the value of the property. So what that means is these are capital additions. As we learned in accounting, whenever you have an asset and you make changes to the assets, improvements that actually increase the useful life or value, we have to add it to the cost of the asset. The same thing for tax. So this $78,750 is going to be added to the Class 3 asset, and we get to take CCA on that. So let's set this up for Mark Avenue. So let's put Mark Avenue right here. So remember, Mark Avenue is Class 3, and Class 3 is 5% versus Class 1, which is 4%. And so the UCC at the beginning of the year, as given in the question, is $703,250. Now, that addition that we made, we have to add it to this class, $78,750. Now remember, the accelerated investment incentive also applies, but it only applies to the net addition. So it is only going to apply to the $78,750. So we add 50%, which is $39,375. And this is going to give us our CCA base. Now, we add that up, we're going to get a CCA base of $821,375. Now, once again, we don't know how much CCA we can take, but let's just figure out on the side here, what is the maximum CCA that we could take? That's going to be the $821,375. And remember, this is in class 3, which is at 5%. And so the maximum CCA we could take is $41,069 if we had enough net rental income. So we'll just park that there for now. Now let's deal with the last property, which is the one on 96 Flagler Street. So let's put this down here. Flagler Street property. Now, this property, if you look at part 4 of the question, was also sold during the year for $653,000. So we'll also start off with the UCC at January 1st. And the UCC for this property was $514,800. Now remember, whenever we have a disposition of a depreciable asset, we deduct the lesser of cost or proceeds. Cost was $570, proceeds was $653. So the lesser is going to be the $570, which is the cost. And remember, there's no more assets left, right? This is the last asset that's left in this class 1. And we have a negative amount of $55,200. Because this is the last asset in the class, it's only the one asset, this negative amount is going to remain negative when we get to the end of the year. And this is called recapture. Once again, remember from chapter 5, if we have a negative balance and it remains negative at the end of the year, that means we took too much CCA. And so we have to add this to income. This is going to be an amount we add to income. And that will reset this to 0. Now, in addition to the recapture, there's also going to be a taxable capital gain because we sold the building for more than the cost. Remember, the cost was $570. We sold it for $653. So the taxable capital gain is going to be 50% of the gain. So the gain was $653,000 minus the cost of $570. So $653,000 minus $570. That's going to be a capital gain of $83,000. We multiply it by 50%. And so the taxable capital gain is going to be $41,500. Now this amount is going to go into 3B when we calculate the net income for tax purposes. So even though this is an income amount, it goes into 3B. It's not going to be part of the net rental income calculation. The only thing that we have to add to the net rental income now is the recapture of $55,200. So let's go back up to the top here and add the recapture of $55,200. So now we've done all the calculations we need, and this is going to give us our net rental income before CCA. So we add up this column. Our net rental income is going to be $33,783. And so now we're going to think, well, how much CCA can we deduct? And so the maximum CCA we can deduct is $33,783. and therefore that's going to bring our net rental income to 0. Now remember, CCA is a discretionary deduction. Taxpayers don't have to take CCA if they don't want to. In this question, it says, what's her minimum net rental income? Well, if she was going to deduct the maximum CCA, which would be $33,783, then her net rental income, her minimum, would be 0. So we know that we want to deduct $33,783 in CCA, but which class should we take it from? If we look at the two properties that are still held at the end of the year, she could take it from the Hart Street property. Remember, the maximum was $70,800, or she could take all of it from the Mark Avenue property. Now, if both of these classes had the same CCA rate, it wouldn't really matter. But because they're different, this is where some tax planning comes into place. The class 1 is 4% rate, and the class 3 is 5% rate. The rule says is that if you have a choice, you should take CCA from the lower rate class. The lower rate class would be the 4%. The reason is that that would save the greater CCA deductions in the higher rate class for the future. Because in the future years, class 3 will give a 5% deduction, whereas class 1 will only give a 4% deduction. So by taking it from the lower rate class, that's going to preserve the higher deductions in the 5% class 3 category for future years. So we're going to take all of the CCA from class 1, the Hart Street property. So even though the maximum we calculate was $70,800, the maximum that she's allowed to deduct is only up to her net rental income, which is the $33,783. Let's just finish off this calculation here. So this will be the maximum CCA deducted. And then to finish off the year, remember this accelerated investment incentive? We have to remove it now. And then this will give us the UCC going into next year. So we work through that calculation. The UCC going into next year is going to be $1,146,217. Now for the Mark Avenue, we're not going to take any CCA. So even though this is the maximum, we can't take any CCA because once again, we can't create or increase a rental loss with CCA. But to finish off the year, we have to remove this accelerated investment incentive amount. And so once again, the balance going into next year for the Mark Avenue property is going to be $782,000. So finishing this off then, we will be deducting CCA of $33,783, and it's all going to come from the Hart Street property. So the final answer would be her minimum net rental income for 2020 would be 0, and there would also be a taxable capital gain from the sale of the Flagler Street property of $41,500. So that brings us to the end of this video solution for assignment problem 7-2. Good luck with your studies, and we'll see you in the next video tutorial.